stock market, and what's your investment strategy when there's a little bit of a downturn in the stock market? Why should you be invested in the stock market? Outside of your 401k or IRA, or maybe you have an individual brokerage account. So, my viewpoint is that when the market turns downward, just let it go. There's a phrase out there, a saying that says you can't catch a falling knife. Nobody knows how far it's going to go down. And let's say it drops 1,000 points, and you're like, oh, for sure that's the bottom, and then it drops another 1,000 points. So if you jump in too early, then it's something where you're going to automatically start losing money on that investment. There's a couple ways of looking at it. One point of view is that you're buying shares of a company, and it really doesn't matter too much what the current price of that share is. Because whether the stock market goes up or the stock market goes down, the number of shares you have always remains the same. That's something to keep in mind, especially when the market turns downward, is that you didn't technically you didn't lose anything. You still have the same number of shares you had the day before. You know, what what probably hurts more is maybe your sense of ego, that the value of your portfolio is less than what it was, as if you were going to sell today. Um, some people panic and think they're losing a lot of money, and then they'll start selling their stocks when the market has turned downward. That would be a big mistake. What you want to do is just hold on to your stocks, hold on to your shares, and wait for the market to turn around. And it always rebounds. It may take a little while, but it always rebounds. So if you're a long-term investor, this is just a bump in the road. You weren't planning on touching that money for another 20 years. So it'll go up, it'll go down quickly, then it'll bounce back up quickly. And sometimes the best thing you could do is just not look at it. As hard as that may seem, it's the best thing you can do is just ignore it. Um, you know, Timing the market is almost impossible. A lot of people say, look, you can't wait for the market to peak, and you can't wait for the market to bottom out. Um, One strategy is called dollar cost averaging, or DCA. You'll see that quite a bit. And it's like, look, you put the same amount of money into your investment week over week over week. And it doesn't matter if the price goes up or the price goes down. On average, you know, you're looking at buying shares over, many, many weeks, and the price will average out. And it's called cost averaging. Some people say, well, look, if I have 10 shares in a company at $100, and then the price of those shares comes down to $50, then I'm going to add to the number of shares at the lower price, and that will be considered dollar cost averaging. So you could do that as well. So why, as an owner operator, would you be interested in doing investing to begin with? Well, if you have a maintenance account in a company, for example, it's probably not earning any interest. It's just sitting there month over month over month, year over year over year, and it could be thousands of dollars sitting in that maintenance account. That's if your company requires a maintenance account. Now, if your truck is paid for, then generally speaking, you're not going to be required to have a maintenance account. But you still want to set aside some money for truck repairs, because truck repairs could be $10,000, it could be $15,000. And you got to get your truck fixed. Unless you have a credit card you got to put it on, you're probably going to have that cash saved up. Even if you did use a credit card, you'd probably want to use it as a means of getting points, or maybe a 2% cash back feature, but you don't want to keep a balance on that month over month, because you'll pay outrageous amount of interest rate on that. You'll pay 15 to 30% interest charge on any balances you keep on that credit card. So the preferred way to do it is to save your money for maintenance. But if you put it in a checking account or a savings account, you're probably not going to get much. If you put it in a high interest savings account, you might get 4%. Now, on average, the S&P historically has returned, the S&P 500 has historically returned 10% return on that investment on average. Some years it's more, some years it's less. So last year in 2024, it returned, I think, over 20%. This year, it's so far it's been around 0%, but on average over the last 2 years, it's been 10%. So let's say, for example, you have $10,000 saved up. Um, you want to put it into, you don't want to put it in checking or savings. You want to put it into an investment account, a very safe investment account. So you want to put it in something like what they call an index fund, or say, for example, the S&P 500. I think Charles Schwab has a very good one. There's other ones out there, and let's say you put $10,000 in that. Well, last year you would have got a 20% return, so you would have made an extra $2,000 on your investment for your maintenance account. So instead of having $10,000, you would now have $12,000. You didn't have to drive any extra miles to get it. Um, so let's think about other types of investment, like an individual stock, like say, let's say, for example, you want to put your money in Nvidia. Nvidia is a very hot stock. That's much more risky than it is as a ETF. An ETF will include hundreds of stocks. So you want to protect your investment. You don't want to take on a lot of risk. Berkshire Hathaway B shares. It's very, very safe. Very, very safe place to park your maintenance money. I'll see if I can put some links in the comments section. But this is how you can manage your money smartly and take advantage of some of these opportunities. Let's say, for example, you got some money sitting on the sidelines and a checking or savings account that, and the market has a big downturn. Well, you could nibble, what they call a nibble, at the stock market. You could put in $100 one day, $500 next week, then, and cost average on your shares. And then if you think it's hit bottom, then maybe you want to throw in $1,000. So this is how you could take advantage of a downturn in the market, and then the market rebounds, and once it rebounds, that percentage on return could be amazing. You could get 20-30% return on your investment if it rebounds. So let's say you put in $1,000 and it went up 30% when it rebounded. That's an extra $300 you could use towards truck payments or truck repairs. So there's opportunity, but with all opportunity comes risk, because you put $1,000 in it, and like I said, it's hard to catch a falling knife. And instead of rebounding, it comes down another 1,000 points, and it's like, oh, that was a mistake. So let me know what your guys' thoughts and opinions are about investing in the comment section below. I'd like to see what other drivers are doing. But it's something as an owner operator you gotta give some thought to, because if you're running good miles, you're gonna rack up a lot of money in that maintenance account. Whether you have it in checking or savings, and you could be missing an opportunity to invest, some of it or maybe all of it in a very safe investment, especially when the market falls. It's like, there's an opportunity there. Now, I don't know if you want to take it or not. That's up to you and what your risk tolerance is. Younger drivers, younger investors have more risk tolerance than older drivers, for example. But I'll tell you, these opportunities come along only every so often. The last big opportunity came along during the pandemic, and the stock market came down quite a bit. And if you had some money sitting on the sidelines, man, that was a golden opportunity. Another investment ETF I like is QQQM, and that's the technology stock ETF. It does very, very well, and it typically rebounds very, very strongly. But if you look at opportunities when the stock market comes down, They don't come very often. You know, it's been 2 3 years since the pandemic. Before then, you know, if you think about when did the stock market come down, you know, you might have to go back to like the 2008 financial crisis. You know, so that was like, you know, a 10-year gap before there was a big opportunity to jump into the stock market. So these opportunities are somewhat rare. Um, some people call them black swan events. You know, they're so rare that you know, investors keep money on the sidelines. They call it keeping their gunpowder dry. Yeah, you know, they keep a little bit on the sidelines just for these opportunities. And when these opportunities do come along, then they're like, you know, I got several $1,000s. I'm waiting for this type of opportunity, for me to, you know, buy more shares of my favorite stock. All right, guys, that's all I got for you. To give you something to think about. Thanks for watching. We'll see you on the internet.